Welcome to This Explainer. Today, we're putting on our expert investment analyst hats to run Diamondback Energy through a rigorous valuation gauntlet designed by the absolute greatest minds in investing. We'll be using the legendary frameworks of Warren Buffett, Peter Lynch, and Benjamin Graham, alongside standard Wall Street models to perform a complete stock analysis. Let's see if this energy giant survives the gauntlet.
All right, here's our game plan for today. We'll kick things off with a quick company snapshot, then apply the legendary lenses of Buffett, Lynch, and Graham. After that, we'll run some DCF and alternative models and wrap it all up with our final synthesis and verdict.
Okay, part one, company snapshot. So, who's stepping into the ring? It's Diamondback Energy, trading under the ticker FANG at roughly $208 a share. They are a pure-play, independent oil and natural gas producer heavily focused on unconventional onshore reserves out in the highly efficient Permian Basin of West Texas. You know, I remember analyzing Permian plays back in 2018 when everyone thought the shale boom was tapped out. Well, the pure plays like FANG that survived that era, they are leaner and far more lethal today.
When you track their recent market performance against the broader S&P 500, shout out to DBS Bank for the data here, you can really see how they've navigated the wild volatility of the energy sector. The cyclical nature of their stock price movements is super clear, and keep that in mind because it's an absolutely crucial factor for our valuation later on.
Moving right along to part two, the Buffett lens. You know, Warren Buffett's first test is always the economic moat. Now, FANG operates in a highly commoditized industry, right? They sell oil and gas, and they definitely don't control the global price. However, their ultra-low break-even costs in the Permian Basin might actually act as a massive operational moat, allowing them to remain profitable even when crude prices take a hit. And look at the management quality. We're seeing extremely honest, very shareholder-friendly actions here. They are literally handing back roughly 50% of adjusted free cash flow to investors through a recent 5% dividend hike and aggressive share buybacks. What about Buffett's favorite metric, owner earnings? FANG generated a massive $5.9 billion in adjusted free cash flow in 2025 and $1.7 billion in just the first quarter of 2026 alone. Plus, debt is very manageable at $14.6 billion relative to all that cash flow. But wait, there is a catch. A remarkably low 0.7% return on equity noted by DBS requires some caution, though to be fair, it was heavily dragged down by a $3.7 billion non-cash impairment charge on their properties late last year. So if we extrapolate that massive $5.9 billion free cash flow figure, we can safely assume Buffett would find an intrinsic value here that offers a seriously compelling margin of safety at the current price, provided commodity prices hold steady. If they do, this cash generation machine would absolutely catch the Oracle of Omaha's eye.
All right, part three, the Lynch lens.
Peter Lynch would look at FANG and immediately slap the cyclical label on it. Why? Well, despite their operational brilliance and flat production guidance of about 500,000 to 510,000 barrels a day, their fortunes are completely tethered to the unavoidable boom and bust cycles of global oil prices. And when you're valuing cyclicals, timing the commodity cycle is literally everything. Now, this is where things get wild. Let's look at the PEG ratio, a classic Lynch metric comparing price to earnings to a company's growth rate. FANG has a forward PE of just 9.93. Pair that with Zacks projecting a monstrous 43.16% earnings growth for the year, and you get an incredible PEG ratio of 0.23. I mean, anything under 1.0 is basically a screaming statistical buy in Lynch's book. Plus, Lynch loves a fortress balance sheet to survive those cyclical downturns, and FANG definitely delivers with a net debt to EBITDA ratio of a measly 0.10. Now, full disclosure, I do have to make a quick assumption here. Our sources don't detail current insider buying or institutional ownership levels, which Lynch normally evaluates closely. So we're assuming standard industry levels for this cyclical play. Regardless, the PEG ratio and balance sheet alone make this a major buy signal for a Lynch investor. Let's shift gears. Part 4, the Graham lens. Let's run FANG through Benjamin Graham's famously strict defensive investor checklist. Spoiler alert, it basically crushes it. It passes almost every single test. Adequate size? Yes. Multi-billions in revenue. Solid dividend record? Yes. $4.20 annually. A PE well under his maximum of 15? You bet. And a price-to-book ratio of exactly 1.5, which hits his threshold perfectly on the nose. To find Graham's intrinsic value, we've got to do a little math using his famous formula. We take the square root of his legendary base multiplier, which is 22.5. We multiply that by the Zacks estimated EPS of $19.14, and then multiply that by an estimated book value per share of roughly $130, which we just derived from their stock price and that 1.5 price-to-book ratio. And the magic number? Roughly $236.60, meaning even at its current $208 price tag, FANG is actually offering a decent margin of safety. For a deep value investor like Graham, FANG looks fundamentally mispriced to the upside.
Okay, moving on to part 5, DCF and alternative models.
Let's step away from the gurus for a second and run the standard Wall Street playbook. Our source data doesn't give us the exact discount rates, so we're building a base case DCF, assuming an industry-standard weighted average cost of capital, let's say around 10%, and a super conservative perpetual terminal growth rate of maybe 1 to 2%. Then we apply that to their incredibly robust $5.9 billion free cash flow baseline.
But here is the thing with DCFs. As you can see by varying our assumptions for WACC and terminal growth, the intrinsic value bounces around drastically. It really highlights the inherent mathematical risk of the model, especially for a cyclical energy stock where forecasting cash flows 5 or 10 years out is, honestly, incredibly difficult due to unpredictable oil prices. I mean, I've seen analysts get absolutely burned trying to map out a 10-year DCF on oil stocks right before a supply shock flips the entire script. Looking at some alternative models, FANG is actually trading at a slight discount to the industry forward PE multiple of 9.98. If we apply that industry multiple directly to FANG, it spits out a fair value of around $191. Meanwhile, the dividend discount model provides a really nice floor evaluation, supported by their reliable, growing $4.20 annual payout.
Finally, we made it to part 6, synthesis and recommendation. Let's bring this all together. When you look across almost every strict value investing methodology, Diamondback Energy appears to be trading near or even below its intrinsic value. Graham calculates at around $236, Lynch sees a PEG ratio absolutely screaming by, and Buffett sees massive owner earnings, even if it's slightly tempered by that low ROE. Only the comparable PE model suggests a fair value slightly below the current $208 trading price. But as an analyst, you have to weigh the pros and the cons. You've got incredible strengths, those ultra-low Permian operating costs, that $5.9 billion in free cash flow, and aggressive share buybacks. But on the flip side, you are constantly fighting the gravity of volatile global crude oil and Waha natural gas prices. A drop in oil from $73 to $64 a barrel immediately hits their bottom line, no matter how efficiently they operate. So blending the insights from Buffett, Lynch, and Graham, here is our final verdict. FANG is a remarkably well-run cyclical asset generating absolute gobs of cash. Graham might actually buy it today, but given the comparable industry multiples, waiting for a dip below $190 might be the wisest move. What kind of margin of safety do you require for a cyclical energy stock? Think about that as you review your own portfolios. Thanks for joining me on this explainer, and keep learning.